Well, thanks to the organizers for inviting me to discuss this paper. So I work at the Central Bank of Chile, right? So just a disclaimer, the views I will express are mine and don't necessarily reflect the position of the Central Bank or its board members. And something else I want to say, I'm going to show a couple of exercises and I had help for that from Italo Gonzalez. Italo is one of the junior analysts at the Central Bank. If you ever get an application by Italo for a PhD program, you should have a good look. By the way, that applies for any other of the junior analysts that we have at the bank. Okay, so having said that, just a brief summary. So this paper applies an approach for estimating a Hank model, matching both macro time series and micro moments, and it analyzes its fit and forecasting accuracy. So following the previous work, so here's two papers of Markus and co-authors, Kai et al. 2021 and Achari et al. 2020. The authors use also in this paper sequential Monte Carlo to make estimation feasible through parallelization. But there's some novelties in this paper, right? So they use a Frontier 2 asset Hank, as in Bai et al. 2022. That model includes Metz-Wouters features. Right? So these features seem to be important to generate good forecasting properties and good empirical fit. The more substantial contribution in this paper is that they do that forecasting accuracy analysis and fit. So I read the previous version, right, the Achari et al. Paper, and didn't see the forecast until now. I think if I had seen them before, I would be a bit more enthusiastic here. So one of the main findings is that the model seems to produce reasonable forecasts. Seeing your charts, it actually seems to produce quite fantastic forecasts, right? So the root mean squared error with respect to the Metz-Wouters rank version is reduced quite significantly for consumption and inflation, as we have seen. And another finding of the paper that Marco didn't comment is that in the previous version, they found that the macro data and the micro moments seem to complement each other in terms of estimation precision. So the posterior distribution is reduced in terms of its, right? It's a more pointy distribution. And that happens both if you introduce micro moments or macro data. If you introduce at the same time, the macro data seems to be informative for the distributional parameters, right? So share of constrained agents and the MPCs. So I think in your previous paper, you conclude that inequality matters for macro and macro matters for inequality, right? So that's one of the slogans of the Hank literature. Okay, so that's a brief summary. As a general comment, I think this paper is yet another important contribution by Marco and co-authors, also in a series of papers by other co-authors that are opening the way for using Hank models for practical macroeconomic forecasting and policy analysis at central banks. And why? So the reason is simple, right? So we need estimated models matching empirical moments to produce satisfactory forecasts and forecast-based policy prescriptions. So I think these papers are very important in order to move forward in the use of Hank at central banks, right? Well, that's the title of the paper. So actually, in the other version, you also find that, well, also in this one, that calibrated Hank models don't seem to produce very reasonable forecasts, right? So you might ask yourself whether these models are useful for other exercises, but of course that depends on the question at hand, right? So at least the estimated model seems to have a very good empirical fit, at least in your preliminary results. Okay, so the rest of my discussion, I never worked with Hank models. I never conducted any sequential Monte Carlo estimations, right? So you might ask yourself, well, why am I discussing this paper? So I do have some experience with using DSG models, estimated DSG models for inflation forecasting and monetary policy analysis, so I'm going to talk about this. And also, I will show you some exercises for Chile with one of our state-of-the-art models that we're using currently. And then some specific comments. So where do I see one of the most relevant points of DSG models with heterogeneity for macro forecasting and policy analysis? So a prototypical rank type DSG model, right, which many central banks use these kind of models, they satisfy the Ricardian equivalence proposition, right? So the forward-looking rational agents internalize the government budget constraint. So among other things, a deficit financed increase in government transfers doesn't affect the equilibrium allocation of consumption output, inflation, and other variables. Of course, it affects private savings, right? Because forward-looking households know that in the future they have to pay the taxes, so they don't change their consumption and basically save the transfers that they receive in order to smooth consumption over time. So agent heterogeneity is one way to break Ricardian equivalence. There's other ways, right? You could use risky government debt, distortionary taxes, or imperfect rationality. And there's other papers, also earlier ones, that already made this point. So two-agent New Keynesian models that have a fraction of hand-to-mouth consumers that consume all of their disposable income, right? Also known as non-Ricardian households or liquidity-constrained agents. In those models, Ricardian equivalence doesn't hold. And, well, of course, in Hank, you have uninsurable idiosyncratic income shocks that generate a wealth distribution and different marginal propensities to consume. So in those models, then the impact of fiscal shocks on output and inflation and also the monetary policy response to fiscal shocks can be very different, right? Actually, they are very different. So I wanted to show you that in one example. So here's the practical relevance of this. During the pandemic, large fiscal transfers were enacted. So you see the case of the US and Chile. Over 2020 and 2021, the average increase in government transfers in the case of the US was about 10 percentage points of GDP, right above the 2013-2019 average. In Chile, we also had a very important increase in government transfers, so here it was 12% of GDP. Of course, in terms of the amount, the case of the US is much bigger than in Chile, but nevertheless, we've also had in Chile an important fiscal expansion, intense in government transfers. And so the timing differed a bit. So one exercise that we did is use our current DSG model that we're using at the central bank. So that's XMAS. It was published in 2019, an extended model for analysis and simulations. So that's a pretty large DSG model. Right? Has a lot of features. It's a small open economy model. It has nominal real rigidities, has search and matching in the labor market, and it has a kind of extends fiscal policy block, right? So among other things, we have government investment and we have transfers. And these transfers have an impact on macro variables because there's non-Ricardian households, right? So we have a share of hand-to-mouth consumers or non-Ricardians that consume all of their disposable income. So in our baseline calibration, so it's an estimated model, in the baseline calibration, there's 50% of non-Ricardians. You can conduct different exercises with different shares of non-Ricardians. So what we did is to to simulate this increase in government transfers as a fraction of GDP over 1 year and the second year equal to 3 percentage points and 9 percentage points, right? So that's what I showed, that's the increase in government transfers in the case of Chile. And then we computed the responses, input responses of private consumption as a share of nominal GDP, responses of non-Ricardian households, Ricardian households. Here's the government deficit, right? So this is a deficit financed increase in government transfers, and the response of output, inflation, and the monetary policy rate, right? So in the baseline calibration, where there's 50% of non-Ricardian households, that shock to transfers has quite an important impact on GDP, on private consumption. So private consumption increases about 3 percentage points. Non-recurrent households increase very strongly their consumption, more strongly in the second year. So that's just a sequence of unexpected shocks. That's why the responses look a bit weird. And then they decrease consumption. Output increases. Core inflation increases, right, quite substantially, almost 3 percentage points. If you increase the share of non-recurrents, of course, the responses are stronger, so that could be up to 5 percentage points. And monetary policy reacts to that, right? So here's a generalized Taylor rule by increasing the interest rate. So in some sense, what monetary policy does here is to make the economy as a whole react in a more Ricardian way, right? So they make non-Ricardians safe, right? Given that the Ricardians safe, right? So they decrease their consumption given that the non-Ricardians are consuming all of it. And that stabilizes at least partially inflation, right? And the output response. And what happens in a rank type of model? Almost nothing, right? So here's risky government debt. So this is a small open economy model, right? So there's some kind of effect. But basically, the output inflation and monetary policy rate response is 0. So then I read a blog of Marco and co-authors, right, that do something like this exercise, a bit of a different one, right, for the US. So what you did in this blog from March is to analyze the inflation drivers in the US based on the New York Fed DSG model. So that's a rank, right? And you have your main findings is that the recent rise in inflation is mostly accounted for by a large cost push shock, right? And this shock is expected to fade gradually over the course of 2022. So that made me think, well, there's no demand, right? It's mostly probably supply side factors that the cost push shock captures. Maybe you could also think that there's some implications for the persistence of inflation. I think in that model you have transitory price level shocks and cost push shocks. And these transitory price level shocks, they capture some of the high frequency movements of inflation. But at least in Smets-Wouters and some other models, the cost push shocks, they are mostly high frequency movements, right? So that made me think maybe some of the idea that inflation would be transitory might be due to this, that there were no demand side factors incorporated in that model. But of course, in the same blog, you recognize these caveats. So you say in our model, the large fiscal transfers enacted during the pandemic have no direct effect on consumption because its representative households anticipates the increase in taxes. But this would not be the case in a model with heterogeneous agents. In such a model, the boost to consumption demand from fiscal stimulus would be larger, right? So I think we're very close to thinking about this in a Hank type of framework. So what happens in Chile? Again, here's a second exercise. So we did something like your inflation decomposition, right, with our model. So here's again the baseline calibration estimation. That's the historical decomposition of annual core inflation, right, with these 50% of non-Ricardians. On the other side, there's the ranked version of the model. So that's the only thing we did there is to set the share of non-Ricardians to 0, but not changing any other parameter. Right? And then we show here fiscal shocks, including transfers. So most of the effect here is due to the transfer shocks. Then other things happened in Chile during the pandemic. There was 3 successive pension fund withdrawals. So households or affiliates to the pension system could withdraw every time about 10% of their pension accounts, right? So these together, they injected more than 20% of GDP, right? So the pension fund withdrawals were even larger than the fiscal transfers. So that's why these blue bars here are also very important, right? And you see how apparently the model, well, the pension withdrawals are modeled similarly as a government transfer, right, from a government fund, and inflation also increases in response to these pension withdrawals. And perhaps the most important point here is that most of the increase in core inflation over the last 1.5 years was due to these government transfers and the pension fund withdrawals, right? Summing up all other shocks, so there's a lot of shocks here, there's about 20 shocks. demand shocks, supply shocks, right? Cost push shocks, external shocks. There's an UAP shock. Some of these go upwards, the other ones downwards. But well, if you ignore them, you see the blue and the red bars are by far the most important contributor to inflation, right? And in the rank model, nothing happens. So how would your inflation forecast look like, right? If you use this kind of model and you have 10, 15, 20% of GDP of government transfers appearing, right? Probably you would forecast a small increase in inflation, right? It would seem very counterintuitive. That's why maybe you would move to a framework like this or use more econometric type of models. But apparently for the practical use of these models, it's very important to have some kind of feature like heterogeneity that generates or that breaks circadian equivalence. Okay, so let me end with some, out of time, so specific comments. I think it would be interesting to use your model, maybe not in this paper, but perhaps a new blog, right? To see whether the assessment of US inflation drivers would change in the estimated Hank, right? So it might be interesting to compare the decomposition that you did with the rank counterpart of the New York Fed TSG model with the estimated Hank. Another question that I had is, so it's very complicated, and well, the email exchange that we had, right, the problems that you have with the servers and well, the footnotes in your paper, it seems computationally very, very intense to solve and estimate these models. Well, your presentation showed that also. So I asked, what do we gain by using Hank over a simple tank type of two-agent model, right, like the one that we are using? So, well, Galli and De Bortoli, they have a working paper from 2017, where they show that the tank model captures reasonably well the implications of a baseline Hank for aggregate shock. So maybe it might be interesting to also compare a tank type of model, right, as a way in between the rank and the Hank in terms of fit and forecasting accuracy. And then two other questions that I have, so it's out of my own ignorance. So I wonder whether it's possible to relax the assumption that there's no household debt in Hank. Maybe in the new version you have some kind of debt, right? Because you have these two assets, but I didn't read that version. But at least in the baseline Hank, there's this borrowing constraint that you can't. Well, there's no debt. And think about, for example, small open economy models. Right? If there's a net debt in steady state of a small open economy, the impact, for example, of a foreign interest rate shock can be very different because the increase in foreign interest rates affect your net wealth, right? But maybe that comment is a bit outdated. And then another one, so whether it's possible to use habit, to include habit persistence in this estimated Hank, or why don't you include that? Was one question that I had. So you showed the chart of Smets and Wouters. If you exclude habit persistence, then the fit declines pretty much, right? So maybe that would be something to think about. Okay, so well, I would like to congratulate the authors for project. Well, it's not yet a paper, it's a project, but for sure this project will become a key reference in the literature on Hank models, especially for central bank practitioners. Well, thank you for your attention.
Thank you, Markus. Now we have some minutes for some questions from the floor.
First, I have one comment and then a question. So Markus's presentation made it very clear why central banks should be interested in Hank models, and I think maybe my presentation gave a different impression, and I want to sort of say that this is the reason you should care, that for many developments, heterogeneity matters. Okay? Mm-hmm. Now the question. So, Marco, you showed, if I understood correctly, that the calibrated model does not forecast well. And I was curious how the parameters differ between the calibrated model and the estimated parameters in that exercise.
Okay.
So I have two questions from Marco. One is about your choice of model, and one is about your choice of methods. So the model you chose is this BBL model. And so that's a model that doesn't have hump-shaped impulse responses in consumption in particular. And so I was curious why you chose that model. That's related to the Discussant's last comment that it's hard to incorporate habit persistence in Hank models. So why you chose that model as your baseline model? Aren't the lack of hump-shaped impulse responses an issue for Bayesian estimation? And then on your choice of methods, it looks like you're favoring these state space methods for estimating Hank models. And so I was curious about why you think the state space methods are kind of the way to go for Hank models as opposed to sequence space methods. And in particular, it sounded to me like your approach, sequential Monte Carlo, it's a way of tracing out a Markov chain for the posterior distribution that takes as a given a certain way of getting the likelihood function of parameters given the data, and that's very easy to do in the state space, in the state space as well as in the sequence space. And so, just why did you opt to go that direction? Thanks.
Go ahead.
I have a simpler, like, application type of question. So, how many computers do you actually use for this? Like, how many nodes do you need? Like how practical it would be for, that's it. Yeah. Yeah. I mean, someone is taking over the server we have at the board. I think I have a guess who is now. But yeah. Anyway.
Thank you very much for the paper and very nice discussion also. So two questions. One is I know this is an unfair question given that the results came at 3 a.m. But so what explains the big improvement in forecasting? How are you thinking about exploring this major enhancement? And one thing that comes to mind is to what extent the Hank estimated model needs less of the frictions that you typically get in the Smet-Wouters model, right? So that's one thing. And the other more practical question is, in estimation of standard ESG models, you require sometimes measurement errors. So how much of that you required for matching the additional dimension of the Hank estimation? Thanks.
Yeah, can you hear me? Good, great. So thank you, all of you, for your questions, and thank you in particular to Markus for a great discussion in spite of the asymmetric information, that is the fact that you had no idea what I was going to talk about up until a few hours ago. Let me touch on some of the few points that you raised. So first of all, I came to present like a Hank model, and I wouldn't think that I didn't expect to find myself defending a rank, but I'll happily do that to the extent that I can, and that's obviously kind of limited. So let me say a couple of things on the New York Fed's interpretation of inflation. First of all, the debate about supply and demand, in my opinion, is a little simplistic for the following reason, that if you think of a markup shock, and arguably most people would agree that there were some cost push shock in 2021, in a period where monetary policy is at the zero lower bound and agents, as they did in mid-2021, expected to be at the zero lower bound for a long period of time, then the impulse responses of those shocks are actually very different from what you would get if monetary policy follows the Taylor rule as unconstrained, for the obvious reason that, inflation shoots up, nominal rates are stuck, expected to be stuck, the real rate plummets, and so the effect of output of that shock goes exactly the opposite direction. So from the perspective of those silly bars that are called shock decomposition, that is still called a supply shock because it's, the source of the shock is a markup. But from the perspective of the discussion that people have about the role of monetary policy and so on, well, monetary policy did play an important role. So from that perspective, part of that is what in the general discussion might have been called demand, and that's part of what explains kind of that decomposition. The other thing is obviously the other key defining feature of that model is that the Phillips curve is very flat. Now, one may question that, and I guess Jim was doing that earlier on, where that's still the case. But given that, I'm actually not sure that your discussion of the effects of transfers on inflation, if your model had such a flat Phillips curve, would be all that different. If you look at the impact on output of those transfers, was pretty temporary. That implies that, if I'm thinking straight, that the present discounted value of marginal cost isn't really changing a heck of a lot. So if in your tank model you had as flat as a Phillips curve as I had in my rank model, I think you wouldn't get an iota for inflation from those shocks, and so the answer wouldn't be, arguably, but I'm just guessing, all that different. But I guess that's a question. And something else that you ask is the Hank versus tank. I mean, I don't have any strong particular ideological position on that. I mean, I guess it depends on the question at hand. And it seems to me that for many empirical questions, there is a richness from looking at the entire distribution, just in terms of, again, data, that is really hard to have with tank models. So you just cannot match a lot of features of the imperial distribution when you only have two agents. And I mean, I think that limits. That doesn't mean, I mean, papers like Florin Bilby, Giorgio Primiceri, and Andrea Trambalot, they have an estimated tank model. They have very interesting results also about inequality and the implication for that for business cycle. That's a great exercise, but there are some stuff that they cannot talk about, and I think Hank just a full-fledged distribution. You're right, for a central bank, you can talk about more precisely about inequality. On the calibrated, let me get to some of your question, Alistair. You asked about calibrated model, how do the parameters change? I mean, what we're doing, just to make sure, we're using the mode of the prior, which is usually informed by standard calibration. That's what we plug in. And so the question is, how does it change relative to the posterior? I mean, again, often those changes are quantitatively. It's not like each parameter is dramatically different from the prior, right? If you ever looked at prior versus posterior, there is a shift, but often it's not very dramatic. Yet, put it all together, you get quite different dynamics. So I'm not sure there's any particular parameter that changes, but it's a great question and one that we should try to address. I mean, Adrian asked a couple of questions. One is why BBL? I mean, I guess I was intrigued by the fact that, again, BBL come out and put forth and say, I'm going to tell you a story about business cycle. And so, what the Hank interpretation of business cycle is. And so it seems like a natural thing to ask, well, how does your model actually fit business cycle data? And that's why I kind of chose the BBL. But there are other great examples of estimated models. And I'd be very happy to use any of those. but that seems like a natural given, a natural natural application. In terms of state-space model, as opposed to sequence-based models, again, first of all, as you said, the sequential Monte Carlo applies to, it doesn't matter, right? It's just a matter of computing the posterior, and your likelihood can be anything that you care about. I mean, I think in practice, there might be some advantages of state space, just because when it comes to interpreting stuff like, the exercise, you can, the smoothing that comes from state space model is helpful and is part of the general way that these models are used. But again, I don't have any particularly strong a priori conviction as to one is better than the other. Again, using missing data is helpful because you don't have all the data, but yeah, I'm very open-minded, and the future can go in very different direction, and maybe in both. I mean, in fact, part of our next task is to really learn a sequence space model. Computing power, that part of the problem is that we were promised we could use the new Fed cluster, AWS. And guess what? There's so much bureaucratic stuff on that it turned out to be, the IT people did a great job, but then when we tried to run it, and we were ready to do that a few weeks ago, it didn't work because all it's really hard. And so we were counting on a cluster, and that cluster, disappeared. And so we had to run everything on a much smaller cluster, which is the near Fed one, where other people are running their jobs, and that's partly why we got to 3 a.m. last night. And I guess that's it. Thank you.